After testing hundreds of breakout strategies across the 14 years of combined trading experience both me and Pedma have, we've discovered something that will change how you think about trading indicators forever. Most traders obsess about finding the one magical parameter value, such as the 32-day moving average, the perfect RSI level, or the optimal period length. But here's the brutal truth. Markets evolve, and your perfect indicator value often becomes worthless or less effective than you would think. In today's episode, we're revealing our top breakout indicators that we've consistently used across crypto, futures, and equities, going from our highest ranking to our lowest, plus our new preferred method of combining indicators to give us a better overall signal. We'll also go over what indicators we would have used when first starting out in trading and how much better that would have been really in hindsight. Let's dive straight in. So in this episode, I wanted to go over the best breakout trading indicators that we've used. Pedma has been specifically trading for about 8 years, and I think at least crypto, he's been doing it from 2021. For me, I've been just trading pretty much most markets for about 6 years. Crypto is the most recent one, I guess, that I've been venturing into. But over that time, we've tested ungodly amount of indicators, at least I have. And I want to go over the best ones we've sort of found, and also a bit of an experience of the different ways you can approach them. I think a lot of people view indicators as a singular or a binary signal, meaning they only apply one of them. But we're also going to talk about a special kind of blend method where you can blend a lot of them together to give you a better overall signal as well. Pedma, do you want to go first with a couple ones you've used at least recently for breakouts?
Sure. So, first of there's different indicators that give you different types of return profile, right? When you are trying to use an indicator, you are trying basically to make a forecast of future price returns. That's why you're trading. You're trying to make some money. So when you trade these types of indicators, there's going to be better breakouts, like breakout indicators, and less effective ones. Doesn't mean that you cannot use all of them. It just means that some are more effective for whatever reason and others are less. In general, these indicators are usually very, very correlated because they are if you measure the returns, their forward returns after the signals, you'll see that those returns are usually very correlated amongst indicators, like 80% or more, because they are all trying to harvest momentum and that type of sort of returns. So the first one is usually Bollinger Bands. That's the one that I find with the strongest predictor of returns. Then you have like normal high and low lookbacks, like a Donchian channel. You look at the previous 50-day breakout or whatever. Those are usually very good too. You have like RSI, buy above 70 or 50 or whatever and sell the opposite. And then you have MA crossovers. Those are usually the ones that I've tested most with, and not any. I've ranked them by strength, at least in crypto, but I wouldn't say that you should that people that trade this type of system should only trade one and one length. For example, people should always be looking at making a blend of all of these, like almost a fishing net. You don't want to use a small fishing net because you're going to catch no fish. You want to use a very the widest fishing net you can, because that's how you make sure that you keep capturing fish and you make it robust, all that stuff. Markets are always changing. It's always good to have a blend of different stuff to capture the same returns going forward.
Yeah, no, I agree. I think my list is going to be very similar to yours. I will also say most of these are very similar to Bollinger Bands. So that's why normally Bollinger Bands kind of rank the highest, because that's the most common indicator I'd say most people use. For me, at least in the futures markets, I've been using a lot of Keltner channels. So that's primarily a similar version of Bollinger Bands, just slightly different formula. Then Donchian, I don't know if you've already defined this one, but primarily this is looking at the highest and lowest prices over a set amount of bars or time. So most commonly, I know people use like 20, but you can obviously do higher and lower. Then there's also like fixed look-back ones. So this is a bit different to Donchian in the sense where most commonly it's like 52-week highs or all-time highs. So if you're looking for a stock that breaks over all-time highs, for example. Then you've got Bollinger Bands. I use those quite commonly. And then moving averages, both in the sense of price either crossing over a moving average. A very typical one of this is like the 200 moving average, which is more like a long-term support, I guess, if you want to say. Or you can do a fast and slow MA, so a classic crossover strategy. And I think a lot of people ignore classic crossovers because, yes, on lower timeframes, they are very noisy. They definitely won't be profitable. But a lot of the times on higher timeframes, especially daily, weekly, on trending assets, they can be still a very good signal. So I still use them a decent amount of time. The last thing I kind of want to go to on this one is to use multi-time frames. Similar to a blend method, for me, I like to get different confirmation from higher and lower timeframes, depending on what the asset is. But for example, in futures, let's say ES is breaking out on a Donchian indicator on the daily time frame, but my actual trading strategy is trading the 60-minute time frame. Then I'm basically looking for breakouts on the lower time frame as well. So in essence, it's what most people would call confluence or fractal, but that's normally resulted quite well for me in the sense where the high time frame is like the regime filter, where you're filtering out a lot of different directions, and then on the lower time frame, that's where you're actually getting your key filter. If I had to rank them, by far, I think for me, Keltner channels have worked the best, at least in futures, especially on indexes, ES and Q, stuff like that. I can't say why, but at least on gold, Donchian has worked a lot better for me for the strategies I've tested. But I would also recommend, as Padma said, to kind of do a blend method where you primarily do it like an ensemble method where you get either, well, actually, do you approach it in an ensemble method or do you approach it where you have all indicators and then you're taking entry for each one of those indicators? Does that make sense? Am I explaining that well?
Yeah, no. I've tested both methods, and usually I just want to do like an ensemble of all signal strength from all the indicators. And I think you're very right in the multi-time frame approach as well, because you want to use different lengths, so right, to capture short, medium, and long-term momentum in the market. It's like I like if you want to capture a certain type of trade of return from a trade, you want to capture it as wide as possible because you don't know which one will be working tomorrow or not working, you know? So like markets are very uncertain and things are always changing all the time. For example, back in the 80s, like short-term trend followers were doing very well, like the early like turtle traders. They were using very short-term lookbacks, and then over the years that stopped working, right? That didn't work as well. So, for example, Jerry Parker, which is still one of the early turtle traders that still trade today, he had to adapt and use more slow, lower frequency signals. And that's why people that use like stuff like machine learning or whatever to try and find the best signal, they are just setting themselves up for failure because there's no best signal. There's only very noisy estimates, if that makes sense.
I was just about to say the exact same thing as you. Yeah, it makes me laugh a bit when I see a YouTube video or someone says, well, the 32 MA is the best resulting one. Because most of the time, that could be true for the most recent look back, but historically, that's not always going to be the same. So having some sort of ensemble method, or, you can also do multiple different parameter values. So you could have multiple different ones running at the same time. That normally works the best. As you're kind of saying, more of a basket method instead of just having one particular value. You can also do what I commonly do as well, is like a walk forward optimization. So this is in essence, you get maybe 3 months of training data, you find the best parameter value, then you run it for whatever 2-3 months, and then you do that process on a rolling basis. And that means you're constantly updating the parameter value over that time, but you can also do a basket method of that, or you can just do a single. For futures, what I've seen work best, at least right now, the walk forward optimization approach has been best for me. I do a basket method on more things like moving averages, things like that. But anything like Donchian or Keltner, normally I can just do it in a parameter value and it's been working fine. There's also just the downside of you run many different strategies on futures. The amount of capital you need sizes up quite quickly because you can't do like fractional contracts or something, right? So unless you move everything to micro, which then has often a bit higher commissions and the spread isn't always as good compared to minis, there's just downsides on each side. But if you're in crypto, running a basket probably makes the most sense.
But you can even run them like, imagine you have a spectrum, right? Between -1 allocation, like -100%, so a full short, and 100%, so a full long. And you can like put 3 or 4 indicators together and blend them into an ensemble method, whatever. And they give you like an allocation between those -1 and 1, so you don't have to run them separately, if that makes sense. You can just put them into the same like composite signal, if that makes sense.
Yeah, no, completely. I do have one ensemble method strategy on futures, and it works quite well. The only downside of it is that it's very easy to add a bit too many signals, if that makes sense. I don't know if you have the same issue in crypto. At least in futures, if you add a bit too many, then you're often getting very noisy results, depending on the time frame. Because for the most part, I try and run between the Well, the lowest strategy I have is 10-minute, and then the highest I would say is like weekly, at least for futures. But you get a lot of the leverage from intraday, so I try and keep most of mine between the 60-minute range, give or take. So when you're doing a lot of different indicators on that, I just get too much noise, even on the
The-
sample method.
yeah, yeah. The interesting thing about crypto is that when you run like trend following strategies, I have always the tendency to go lower and lower frequency to use the same method that I would use in other markets, right? To lower frequency stuff. But the interesting thing is that if you go very low frequency on crypto, they don't work as well. Imagine start using like 100 days or 200 days look back, stuff like that on signals. They don't work as well as using like a 10-day or 20-day look back, which is quite interesting because crypto is very volatile and it benefits from this like short-term explosive nature. So when you put too much together, like too much low frequency stuff together, it actually makes the results much worse than if you put more weight on the short-term stuff.
I do think for whatever reason, I've never seen anyone get into trading and instantly want to do lower frequency stuff. We all kind of get pushed to it, at least for me, because like I remember when I first started out, I was thinking 1 minute charts, maybe even a 30-second chart, But those sort of charts, especially just on lower time frames, you get so much noise. It's so much more difficult to create a reliable strategy on those time frames. And a lot of the times when I do see people say they found a reliable signal for it,
They didn't.
yeah, that, and then most commonly, it's a lot of cherry picking. Where if you have some sort of discretionary overlay, then maybe it could be profitable. I'm not saying it couldn't. Like I know scalping on Thinkorswim was very profitable because they had no commissions, and like if you had somewhat good of a read of the order flow, at least from what people said, you could do very well. But unless you have that sort of skill layer on top, it is very difficult to create a systematic strategy that would historically work well on those lower time frames. I don't think I've ever found one that's consistently worked well.
I agree with you. I've seen like I've seen traders that do well, like scalping and stuff like that. But like of the hundreds, if not thousands of traders that like no hundreds, I'm not going to exaggerate, traders that I know, like maybe no one or two that apparently make like do well in those types of trades because it's a very noisy it's a very noisy time frame, right? Because everyone, first and foremost, everyone wants those type of trades. Because people that do this business professionally want the most statistically significant stuff that they can find. And when you can trade 100 times a day or 200 times a day, that's really statistical significance, still significant in just a few years of market, right? And so
Yeah.
everyone wants that. And you are competing with the best of the best for those strategies. So you either can say, oh, maybe I can compete there, which I would argue the point, or you can say, okay, no, I can build something first that is more low frequency. Like it won't be as great of a strategy. It is true, it won't, but at least will give me the confidence that is something that is robust and should work in the long term, and then build off of that. If then you feel like you can build a very high frequency type strategy, then go there. But I wouldn't start there. I would, unless you have very specific skills.
Yeah, I would totally agree. I think I was trying to find if I could find the tweet, but someone was doing a backtest of a lower time frame crypto strategy, and he was showing the different effects of performance based on what the Binance fees were. So from I can't remember what you guys call them, but it's like the standard fees to like VIP fees or whatever, based
Yeah.
on how much trading size you have. And the performance is incredible, but only if you have VIP fees. And that is a very big point with anything that's lower time frame is you are going to get more affected by slippage and fees than any other sort of higher time frame, lower frequency signal. And that is a very difficult thing to overcome. Having those fixed costs on every single trade, if you just mess up a bit of execution here and there, or if your signal decays even a bit, you instantly basically lose your edge.
Yeah, trading costs money, and you should trade as the least you can trade as possible, and trade the things with most edge.
Like I know it's Robert Carver's kind of classic thing. I know Robert James did a tweet on it recently, was saying like, you can get away. Well, sorry, you can be more closer to profitability by just not doing all the dumb shit, which is overtrading for the most part. Everyone likes to have trades on, especially because I'm quite fortunate. I get to talk to a lot of traders that want to automate their strategy or backtest their strategy, and one of the most common pieces of advice I try and say is that like do not come in with the idea that you want to create an automation that has 2 trades a day. Can't guarantee opportunity, and when you try and do that, you're just forcing lemon out of a fully squeezed lemon. It's going to be the worst kind of edge, and if it's most of the time it's not even going to be an edge, and you're just not going to make any money on it. So try and approach it in the sense that you can build multiple strategies that maybe then can increase your signal frequency, or you can add more assets or more instruments, etc., which could do that. But trying to force it out because you want to go lower time frame and reduce the amount of filters or whatever, mostly just ends up with bad results.
Yeah, completely agree. It's like people overestimate their edge on the individual trades. Um, it's really hard to find real edge in the markets, right? And thinking that you're going to have 2 or 5 or 10 good trades a day, it's kind of naive. Unless unless you like, I'm not talking to a professional that is doing market making or HFT, right? I'm talking to the average retail that comes to this game, thinking that, oh, I'm going to hit this 2 or 3 trades a day and make an income like that. People want to feel productive. They have a job, or they come from a job that they like. They need to feel productive, and in markets, it's usually not the case. You are more like a hunter or a fisherman, right? You need to know your spots. You need to be there. But most of the time, you're just waiting for your prey to come by and for you to hunt. That's exactly it. Like most of the time, I was writing about that even this weekend. Like most of the times, I'm losing money. Most of the times, I'm doing nothing. And a few times a year, like there's a very strong regime, or every few years, and that's when I make most of my money. But most of the time, it's pretty boring. I'm just writing, coding, and that's it.
Yeah, no, I completely agree. Kind of bringing it back to the breakout indicators. One thing I did want to say on the topic is if you're building your first strategy, or you're looking into the first kind of like idea you want to test. In my opinion, I think breakout strategies are a great first thing to test.
Yeah.
I can't remember what author was saying it. I'll see if I can put the book in the description. But he was primarily saying like if you're getting into systematic trading, your first strategy should be a breakout strategy. You're taking long only, which means for the most part, most markets you'll be trading are directionally long over a long enough time horizon. You can also simplify this down to being on a higher time frame, and you'll most likely not lose a ton of money if you're doing just a simple breakout strategy on a daily or weekly time frame. And that's a great introduction to backtest your first idea. It's not going to, do outsized returns in most cases, unless you're maybe taking on more risk, maybe in crypto. But for the most part, it's a great, easy thing to test. It's not very difficult to code, and it's just the first practical application you can get out and start testing. You don't even need automation for the most part to do, a weekly time frame breakout strategy. Maybe you'll need a bit of code for backtesting, but apart from that, I'd say it's a very nice gateway sort of into systematic trading.
That is so true. Like, so I began trading in November 2017, right? And the first time I've made money, like that I remember ending the year positive or slightly positive, was in 2020. So during that time, the S&P 500 appreciated like almost 50% during that time. And contrary to that, I was losing money during those 3 years, or 3 years. So if I had stick to that advice, like just take not guaranteed trades, but get some exposure to that directionality, like momentum, stuff like that, and then focused on more active trading on the side, I would have made money and built up my capital on the side and still traded whatever I want to trade at that time, right?
Yeah.
But no, I was on the sidelines trying to trade a strategy that I didn't know. I didn't know any better. So
I agree. I also I vividly remember this may sound crude, but I remember getting into trading. I saw a lot of these. Well, I'll simplify this down. When you get into trading, most of the time you kind of have, at least when I got into, well, you had 2 directions. You either went full day trader or you went maybe swing trader. And at least in my head, I was like, what? I'm not going to be a pussy. I'm not going to be a swing trader. I'm going to take on more risk. I want to take on more trades, day trade stuff, trade volatile stuff. And I agree. If I'd probably just stuck with doing some easy swing trading, it's not easy, but it is a lot less likely you're going to blow up an account swing trading for the most part, especially if you're taking very solid just breakout signals. If you're, over leveraging, if you're having a super tight stop, those sort of stuff, then of course you can run into issues as well. But I was fortunate. Then I came across small caps, and then there was an edge there that I could exploit. But for the most part, I definitely would have preferred sticking out with something with swing trading and then building from there. It's also a great portfolio builder, in my opinion. Like having a long or high time frame, long trend sort of strategy that's breakouts, great. You can build everything around that. You can build a mean reversion next. You could build a lower time frame breakout strategy. You could build something that's more pure inefficiency. Let's say like if it was small caps back in the day. It's a great way to pad your initial account. And it also, just to kind of simplify this down even more, because if it is your first strategy, it's going to be your first time going for a drawdown. It's going to be your first time taking losses, things like that. Those are a lot slower to normally happen most of the time in swing trading, meaning you have more time to mentally process it. Taking a $2,000 loss in a couple of minutes, like I did back in the day in small caps, that's very difficult to mentally process. It really shocks your whole day, maybe your whole week. If you can kind of understand how the process is on a swing trade, where you have a bit more time to process that you're going to lose on this trade, etc. At least in hindsight, that's probably what I would have done.
Yeah, I agree. Like make your base first, like a base that you can rely on, and then build off of that.
Yeah, it's also something you can do with a 9-to-5 job.
Yeah, for sure. I had a 9-to-5 job, so
yeah. if doing swing trading is a lot less intensive, and then also the automation on that side of things, like if you did want to get into it, is a lot simpler. So if you wanted to experiment out with it, build your first automation, it's a great way to do it.
Yeah, even like let's say that someone is trading equities, just extracting from Yahoo Finance, putting on a Google Sheet or an Excel, and getting the signals there and passing them to the platform is quite straightforward. If they want to go a step further, even better. But yeah,